So I found an interesting set of properties. It's a total of 14 units, and it looks like on paper that it should be a fantastic deal, but in the end, I actually think that I'm the problem why it wouldn't work. Let's take a look at it. I'm James Furlo, helping investors maximize their long-term cash flow while minimizing headaches, and this is a property analysis. So here's what we're looking at. It's two separate buildings that are 5 units each. Now, what's not listed is this building right here, which could also potentially be sold if someone bought this one. And so I'm actually gonna look at all 3 of these. So the price here of $820 doesn't matter because it doesn't include this third one, but we're gonna make up a number anyways because we can and try to get an idea for what it is. Let's take a look at the description. Looking for a bang for your buck deal in the heart of Medford? If so, this one's for you. All right, that's me, I'm always looking for a deal, right? 2 5-plexes on 1 commercially zoned lot. So all 10 units are currently under rented. And when we look at that, that is 100% true. 1 hot water heater serves all the units. Now, I'll be honest, I've been looking at the picture trying to figure out how that works. Is there like an underground pipe somewhere? Or do they mean there's 1 water heater per building? I don't know. It's kind of interesting. It's funky, which I love. It gets me excited, to be honest. But that's what we got. And so it's got a large basement and attached garage for extra story or an opportunity to add a coin-operated laundry machines. So that would be very cool. And each unit has its own gas and power meter. And the owner covers water, sewer, and trash. So when I hear that, I go, ooh, here's an opportunity to do some bill back for the utilities to increase the income. Over the past few years, the owner has installed a new roof, awesome, on each building, and they've done a bunch of updates. So that means there's not going to be a whole lot of repairs that have to happen. And when we flip through some of the pictures of the insides, you can see it's actually in decent shape. There's some pitting here going on, so there might be some appliance issues, and honest, these are older cabinets, but these here look nice and new. Beautiful living room, though I gotta be honest, clearly the person who did this had a really good camera and just did a great job on lighting. You can just tell from the way the photos look. And this paneling's different, to say the least. But hey, you know what? A place is a place, and it's clean and safe, so that's a win. Again, this is kind of a, ooh, look at that right there. That's gonna need some work on it. And that, so, you know, kudos for them for not just showing the best of the best units. They kind of give a good mix. All right, so there's some work that would be needed. Here's the outside of the second 5-unit place. Now, if we look at the map, so we've got these 2 here, and then this is the 3rd unit one. And let's just see, where in Medford is this thing located? Oh man, it is like dead center. Awesome. All right, cool. Let's take a look at the income numbers. So here's what I have been given. So you can see the breakdown. There's a 3-bed, a 1, another 2. There's a studio, there are a couple studios. In the other one, another studio, then a whole bunch of 1-1s, which is fine. And then that 3rd one, which is currently off market, has a 2-1, 1-1, a 3-1. So it's kind of a mix of a whole bunch of stuff. On the expense side, I wasn't given the details that I normally like to have, but that's okay. So they give us water by month, and same with all the other utilities here. In my opinion, it's a little hard to tell. It says that it is calculated for all 3 of them, so that's what I ran with in my underwriting, and the numbers kind of worked out where you go, yeah, that feels about right. It's a little weird to get like a monthly property tax number, but I get it. You just take that number and divide it by 12. It is what it is. So we got a total expenses of $2784. Let's throw it into our property analysis tool and see how it all shakes out. One of the first things that I do in my spreadsheet is a ballpark analysis. It's a real simple way for me to just go, all right, are we in the ballpark? So here I put in the gross annual income, and that was essentially me adding up all 3 and multiplying it times 12. I always assume a 15% economic and physical vacancy, and then I put the annual expense rate at 50%. And that is a conservative number. And again, I'm just trying to figure out the ballpark. But in general, it's somewhere between 50 and 40%. And then a market cap of 6%. And in Oregon, sometimes it's a little bit lower. I like to buy a little bit higher. And so I came out with a valuation of just over $1 million. And interestingly, when I got some insider information that the owner may be willing to accept 1.05 for all 3 of them, I went, you know what? We're in the ballpark. Let's keep rolling. Here are the breakdown of those units from that spreadsheet. There's 14 units for a current average of $847. Now they said the rents were low, so I did some research to see what they actually are. Looking at Rentometer, which is my favorite source for just quickly getting an idea for what rents could be, it appears, yes, rents are absolutely low. They could be for a 1-bedroom, $1,200, for a 2-bedroom, $1,400 maybe. And then for a 3-bedroom could be as high as $1,600. And so that's what I threw into the spreadsheet. All right, that's not 100% true. I clearly went conservative on all of them. I just made sure to round down because I want to make sure that I can absolutely hit those numbers. And seeing that some of them are going to need some work, I may or may not be able to hit the average. So that's what I came up with. I threw in that purchase price that they were asking for, the 1.05. Here's the heart of the model, where we actually put in the income and expenses, which determines all the other outputs and returns. We start with the marketing package, and this 142 is the number that they gave me. And then I had to add the expenses. And again, these are the numbers that they gave me, just all of them multiplied by 12. The in place is where I actually think it will start being. Now, I've got a gross potential rent of 205, and that is if I think I can get every single lease to the maximum value right away. Here's what I actually think I could earn. But I can't. I know that. I got to get back down to that 142. And so that's a 44% increase that would need to happen, which that number there gets me excited because I go, oh, cool. There's a lot of built-in upside. I also add a much bigger vacancy. There's my 15% that I have assumed, and they don't have any, and that's totally fine. We'll just add that. Now, the really, really, really big one that I added that they did not have is right here. It's a management fee. And that's simply because I don't live in Medford and someone else is going to manage it. And that's how I scale my business. Maybe they have one. Maybe they're self-managing. I don't know. Either way, that's the number that needs to be built in. Their repairs and maintenance number also seemed kind of low to me. I didn't change this one directly, but I did add a contract services, and that's simply for lawn care. And I said it's going to be a couple $100 every single month. And so combined, that gets me up to a 6.7, which feels a little bit more comfortable. And I'm okay with it being low at the beginning because I know I'm going to be doing some work to fix up the units and turn over the place. The other change that I made was I added a replacement reserve of $300. And that's because there's 3 different buildings that have all different utilities and hookups. So normally I do $250 per unit, but in this case I'm doing $300. And so that feels like it's pretty good. Once it's finally done, I'm going to say, yeah, I'm going to get almost all of them up to what the rents need to be after I do all my stabilization work. And then all the other assumptions are the same except for that repairs and maintenance. That's one I actually raised it up to 8% so that combined I'm almost at 10%, which feels like a comfortable assumption for me. There's one more interesting thing about this property, and that it's the seller was willing to give me a loan for that third property up to 90% loan to value at 7% interest if I bought the other one conventionally. I had to do some math to say, okay, what's the overall loan to value for the entire purchase? And that comes out to 48%. And that gives me roughly a 70% loan to value for the main mortgage. And then this second here, it says only 20%, but that's because it's 20% of the total purchase, not for that singular building. And so there's a little bit of a blended rate there. All right, now we have all the information we need to look at the results and see, is this a good deal? We've got that purchase price of 1.05 for the 14 units. And I said, I think we're gonna have to rehab 7 of the units and we're gonna spend $70,000 doing all of that. So that's about $10,000 per unit. And then I said it's going to take 12 months to complete all of that. Now, it's not actually going to take 12 months to do the work. It's just going to take 12 months to get all the leases renewed and get all the rates increased, which may not be the most conservative number out there, but that's what I'm going with for now. So it'll be a total project cost of $1.2 million, and the equity needed to do this is just under $500,000. Now, an interesting thing about this is when I look at the internal rate of return, it's only 9.8, which honestly is less than what my minimum is. The cash on cash is 4%, not bad. An average annual return of 21%. Again, not bad, but not like amazing. And then an equity multiple of 1.68. Now, interestingly, my capitalization rate is huge. It's 7.3, which you don't see in Oregon. Usually it's closer to like 5, sometimes even 4.5%. And so this got me a little confused where I was like, okay, this capitalization rate looks awesome. This should be a fantastic deal. Just like in my ballpark, I went, yeah, this like should work out. And then when I was looking at the internal rate of return and some of the cash on cash, I was like, this deal just doesn't seem to work for my investor base. What's going on here? So I started playing around with some of the numbers. And of course, like anyone, I started with price and went, okay, maybe the price they're asking for is too high. Let's try lowering it. What if instead of 1.05, I get greedy and say, I'm only going to offer him $900,000. To be honest, I don't think the seller would go for it, but let's see how this impacts it. So this gets my internal rate of return up higher. My minimum's 10%. So now we're right in the bell horn of where it needs to be. My cash on cash honestly looks great. Again, you don't see this very much in Oregon. And my equity multiply is almost at 2, which I like. So now we're getting a little bit closer to what this deal needs to be. So everything looks great. Obviously, if I could get it for $900,000, I would be super interested. That's when I took a turn and said, you know what? I actually think the problem with this property is me. Let me give you a little sneak peek into under the hood on how I measure some of these returns. First thing we're gonna do is we're gonna put this price back to 1.05 so that we're back to where we were originally, just so you can see. So again, internal rate of return, 9.8. Let's keep track of that number because that's an important one. Now in my underwriting model, I'm gonna zoom all the way over. I've got a whole bunch of assumptions here. I've got a common equity assumptions area, and this is where I can kind of tweak and change how much I earn. So right now I've got it where I'm contributing 1% and members contribute 99%. Now I'm going to change this to say, what if it's not a syndication, it's just a regular purchase? In other words, I'm an investor, I got some cash, and I want to go buy this for myself. So I would pay for 100% of it. There's a tier 2 promote, and that promote is what I get paid as part of the deal. In this case, it's 20%. Well, we're going to say it's none because we don't have anybody like that. And then the tier 3 promote, also 0. The last two that we want to change are around an acquisition fee, which is 2%, which is $21,000. So we're not going to have that because it's just a regular standard purchase. So we make that 0. And then there's also an asset management fee. And this is what I get paid for just the ongoing looking at this asset. And again, we're not going to have that. So we make that 0%. So effectively what we've said is there is no other investor. There's no sponsor. It's just me, if I were doing it myself, just doing the deal. Now let's take a look at these results. Okay. This is what I was actually expecting to see. Now we can see the internal rate of return is up to 14%. That is where we want it. And so ultimately, my conclusion here is that I was the problem. For whatever reason, the way that the cash flow works on this deal, and we could dive into the numbers if I wanted to, we can see that it's paying way too much to me for this type of property. Because now we're at that 14.1 and we've got an equity multiply of 2. Like all these numbers, they'll work. This is exactly what I would want to see from a property return standpoint. So I think this is a perfect property for someone who's got, $500,000 sitting around that they are looking to buy something. This would be a fantastic purchase for them. They'd make a good return. And don't forget, this is still paying a property manager to manage everything. And that also includes putting $70,000 into the property to make it even better than the work they've already done. And thankfully, they've already done a bunch of the large system updates, so it wouldn't be terribly bad. That's my opinion on this one. It's an interesting property, and I like it because it shows some of the potential downside of doing a syndication. It really is designed for a specific type of property that's either specific size or has an amount of value add to it. And this one, for whatever reason, is just perfect for a classic investment, not a syndication. So thanks for watching. I personally found this one really interesting, and I hope you did too. Now, if you'd like to check out another property that I analyzed, it's 40 units and they're asking $4 million for it. And that's one that is just like catnip for syndicators like myself. Thanks for watching.